With the benefit of hindsight, we look back on it now and we think that actually we missed out on many years of investment which actually would have served us very well now, and we're now paying the price.
Investment isn't just about buying great assets, you need to buy them at the right price as well. That's why savvy investors pay such close attention to valuations, those measures of an asset's price relative to other factors like the income it pays or the earnings it makes. With a little bit of knowledge, you can use these measures to compare different assets and make a judgment about which ones are cheap, which ones are expensive, and therefore which ones have the best chance of making you money in the future, in theory at least. That is what we've been doing this week in relation not to individual companies but to the stock markets of whole countries. So, to run through the cheapest and the most expensive stock markets in the world right now, I'm joined by Tom Stevenson, Investment Director here at Fidelity. Tom, welcome along. Let's just say at the start here that neither you or I can take credit for the work that we're about to discuss. This was all done by our colleague, wasn't it, Richard Evans, who was writing about all of this week. But why don't you start, Tom, by explaining the work that he pulled together this week?
Yeah, so as you say, valuations are an important factor in deciding where to invest. I mean, we talk a lot about different markets and we say, X looks better value than Y.
Yeah.
And so what Richard has done is essentially look at the main measure of what we're talking about there, the main valuation measure for markets, which is something called the price earnings ratio. And as its name suggests, it's a comparison of the price that you're paying for a share with the underlying earnings of that company, or in the case of a market, it's in aggregate the overall price for the market with the overall level of earnings of that market.
And just on that point about the price to earnings, and what you come up with is a number, it's a ratio, I suppose you'd say, between those two things. We'll get to the kinds of numbers we're talking about, but it might be very low at sort of 5 to 10, might be very high, sort of 25, 30 plus, whatever. But it's the number, that's what that number means.
Yeah, and broadly speaking, what you're looking for is a relatively low number because, a high number means the market is relatively expensive, a low number means the market is relatively cheap. So all other things being equal, you want to buy a market or an individual share as cheaply as possible. So you want that number to be as low as possible.
Yeah, and specifically, he's used a version of the price to earnings ratio. So what was that?
Yeah, so he's used something called the cyclically adjusted price earnings ratio.
Skips off the tongue?
It skips off the tongue, even better when you shorten it to CAPE.
CAPE, yeah.
And so what cyclically adjusted means in this case is that rather than using one number for the earnings to work out that calculation, that ratio, it uses a period of time, usually 10 years, takes the average of that, and that's why it's called cyclically adjusted, because what it attempts to do is to even out the ups and downs of the cycle. So because what can happen is if you've got in an economic cycle, when you might have a recession and you might have a recovery, then that price earnings ratio can swing around quite a lot. So it can actually be quite misleading. Yeah. You might end up with a very high PE ratio, but all that means is that the earnings are at a low point of the cycle.
Sure. And before we get into the specifics of the valuations now on different stock markets around the world, what else do you need to know to kind of make use of these measures? Because it always strikes me when we talk about them that, you might look at one market as being cheaper, having a lower number, a lower price to earnings or CAPE figure than another market. But you need to understand something of the context, don't you? Because there might be really good reasons for that. There might be structural reasons why one market is valued more highly. It's not enough just to look at the number.
No, that's right. I think, there are a few things to say here. One, I think, is it's important to look at that number within the historical context for that specific market.
Yeah.
So you might say that, the UK looks cheaper than it has done in the past. Yeah. So that's relevant. You're also looking comparatively. So you might say, well, the UK looks cheap compared to the US. So those cross-market comparisons are also important. The other thing to bear in mind is you're not just looking at that ratio, because whether that ratio is cheap or expensive is also determined by how fast those earnings are growing. So
Sure.
we don't need to go into it now, but there's this something called a PEG ratio, which compares that price earnings ratio with the growth rate. And again, you're looking for low to be good.
And just to make that kind of all that sort of live for people, it's a bit like if you're buying anything else. If you're buying a car, say, you've got two cars to choose from, you could just compare the price of those two things, but that doesn't really tell you much. You need to know what you're going to get for your money, right?
They do different things.
They do different things, and one car might be more prestigious or more reliable or newer or what have you. So you need to know all of it to know whether you're getting value as well as cheapness.
Yeah, all of these ratios are a kind of shorthand. They help people to sort of fix things in their mind, to give them a sort of sense of the landscape. But you actually need to sort of look under the bonnet and see what you're getting.
Yeah. Okay. Well, let's get into some of the figures now currently for world markets. I'll say here that I'm keen for this to be as usable as possible for people, because we're going to talk about lots of different stock markets that, frankly, you may have exposure to within a general global fund, say, but you're very unlikely to have specific market exposure to all these different country markets. But there's certainly some examples of countries where you definitely will have big exposures to. So we can dwell on all of it. Okay, so we're going to start with the cheapest stock markets around, Tom. These are those with a CAPE reading below 15, actually sometimes a lot below 15. The lowest is Turkey, down at 8.6 CAPE. Very, very cheap. We've got Brazil at 11, Poland almost 12, South Korea just over 12, Hong Kong 14, and China 14.6. So all of those markets, very different places in the world, but all looking relatively cheap right now.
Yes, and I think that the thing that draws them all together is in most cases they're what we'd call emerging markets, and I think that's probably the key factor here. That with an emerging market, you would expect a higher degree of risk, maybe. Their economies are less mature than developed markets by definition, and so you would probably expect to pay a lower ratio. You'd expect them to be cheaper to compensate you for the fact that there are more risks to take, and some of those are particular example. You mentioned Turkey as being the cheapest market. Well, they've got significant political issues at the moment. They've got a big inflation
currency problems.
There is a reason why that the market is cheap, and the reason is that there are lots of underlying problems. You also said that people are not going to have exposure to all of these. You're very unlikely to have a direct exposure to the Turkish market, other than in a general emerging market fund. Maybe the one market there that you would have direct exposure to is China.
Yes,
I'd say. And China has been extremely out of favour, extremely cheap. It's actually had a really good run recently. I mean, as there's been a bit of a rotation in markets away from the markets which have done very well, like the US, its money has been seeking out some of the less popular markets, and China is definitely one of those.
And what you can see when you look at a chart, we can't show the chart, but when you look at the chart of these measures over time, somewhere like China, it's not like China's never been highly valued. China has been incredibly highly valued in the past. It's fallen away somewhat. And I mean, you could take guesses as to why that is, but there was some time in the last 10 years when it just began to be less highly valued. Perhaps there were other markets that were sort of stole its mantle somewhat in terms of the kind of growing, exciting new market. Political issues, sort of issues of transparency, those kind of things maybe take hold. But it's clearly a market that does have the potential to get back to higher valuations. And that's kind of an important thing to know when you're looking at it being cheap now.
Yes, and that's why it's important to look at the historical context to see where a market has been in the past, to see whether it might get there. And you're right about China, and there have been a whole string of reasons why it's fallen out of favour. Most of those actually look a bit better. I mean, one of them you didn't mention there was the state of its property sector in China. It's been a real problem. A lot of investors have shied away from China because of that. They've also been concerned about policy issues. All of those are starting to look a bit more interesting now.
Okay, so let's move on to the sort of slightly higher valued markets in the 15 to 20 Cape range. We've got the UK at 17, Mexico just above that, South Africa 17.5, Spain 18, Singapore 18.7, Israel 19.3. Obviously, the UK is going to be of the most interest there, down at 17.1. How does that stack up? Well, how does it stack up against its own history, first of all?
Well, I mean, it's relatively cheap compared to its own history. I mean, I was having a look at some of these Cape charts earlier on, and the UK, I think, stands out actually as being one where, yes, it's been up and down over the years, but if you look over a long period, like a sort of 30, 40-year period, the UK is actually similarly valued to how it was a long time ago.
Yeah.
So, and that's not true of other markets, which have become progressively more expensive over time. So I think that the UK does look quite interesting on a pure valuation basis.
Yeah, and the elephant in the room here is the US. We're going to get to that. It's at the end of the conversation. But you can see when you look at those two markets that they actually sort of matched each other for quite a few years. Then things began to change, particularly at the sort of around the time of the financial crisis and the period since. And there's an obvious thing we can reach for as an explanation, which is on the US side, you've had the growth of tech. I don't want to talk all our US stuff now, but the growth of tech and this exciting new industry. The UK, you feel that global markets view it this way, is dominated by very, very mature industries that don't have a whole lot of growth ahead of them. They might have lots of profits ahead of them, but they're not going to suddenly break new markets or wow the world with some great technology that changes it. It's simply a case of sort of churning out those numbers. That's perhaps why the world doesn't see the UK as worth a higher valuation, maybe.
That is one of the reasons, I think. It's an important reason. I think that the sectoral exposure of the UK market is not as attractive as some other markets, the US in particular. But I think over the last sort of 10, 15 years, there have also been a number of other factors at play. Political instability has been, very important in the UK. I mean, even you go back beyond Brexit, which is now nearly 10 years ago. You go back to the Scottish referendum about 12 or 13 years ago. Yeah. We've had lots of political instability since Brexit, with the Truss government and then all the other things which it shared with other markets like the pandemic. But there's been a lot of long-term instability.
Yeah, and the market in particular has paid attention to the productivity problem in the UK. I don't have the answer to that, but it's been interesting the discussion around that because particularly in the period since the financial crisis where we decided as a country, or the country's government decided to really cut back on spending at that time, to cut borrowing. It saw debt as the real enemy. Now, as it happened, interest rates were very low and you could have borrowed lots of money at that point, and we didn't do it. Later on, we've borrowed more. Some of that's been imposed by things like the pandemic, but it's been during times when rates are higher. We've just been on the wrong side, basically, of a couple of sort of big fiscal decisions.
Yeah, and I think it's very easy to say these things with hindsight.
Absolutely.
I think at the time, immediately after the financial crisis, that what came to be known as austerity probably seemed like a sort of prudent, sensible thing to do. I think with the benefit of hindsight, we look back on it now and we think that actually we missed out on many years of investment, which actually would have served us very well now. And we're now paying the price. 15 years on, we're paying the price for a lack of investment in the sort of the fabric of society, the underlying building blocks of what makes a modern economy. And it's going to take us years to catch up on that, which is what the new Labour government has identified as being a key problem.
Yeah.
That's one of the reasons why we have this productivity problem in the UK, and they're trying to sort it out. But whether they can do that in one term or two remains to be seen.
Okay, well, let's move on for now, Tom, to the markets that are beginning to look a bit more expensive. We've got Italy at 20 and a half times Cape. Europe in general, actually, is on here at 21 and a half. Australia 22. Japan, which is an interesting example, just above 22. Sweden's about the same. Germany 24. France 24. So some quite large markets there. Probably people will have some exposure through global investments, and certainly any European investments will have a lot of that. Some of these markets are already seeing the benefit of a rotation away from particularly the US, a very highly priced US market. They're beginning to look reasonably priced.
Yes, and I think if we'd had this conversation, even a year or two ago, they would have appeared somewhere else in this table. I do think that in both the case of Europe and Japan, you mentioned those specifically, they've had quite strongly performing stock markets. Europe, in particular, over the last 6 months or so, has done surprised everyone really with how well it's done. Both of those cases, both Europe and Japan, were very out of favour with investors. They had sort of what were perceived to be quite deep-seated problems, and they both appear to have overcome them in different ways. They're very different stories, but in both cases they've done well in performance terms, and their valuations have gone up accordingly.
Yeah, and in the case of Japan, I mean, it's interesting to look at its stock market, one of the major markets of the world, over many decades. It's probably the market that's had the highest valuations in its history. Not now, but in the past it has. It's probably not going to get back to those levels, but it is a very large economy. And it could become more highly valued in the future.
Yeah, I mean, as I said, I was looking at some of these Cape price earnings ratio figures early on and looking at the charts, and the one for Japan was really striking actually, because it's going back a long way now, and it's going back into the late 1980s when the Japanese market peaked, but at that time its shares were extremely highly valued, and they became extremely undervalued. So this is a classic example of looking at the history of the internal history of valuations and see where they could get back to. You're right. I think it's very unlikely that Japan will get back to those very high valuations.
A lesson maybe in how the world's impression of a market and a country can change. You ask anyone in 1987 about who sort of owns the future, they'd probably have said the Japanese, wouldn't they? And yet no longer.
Yeah, absolutely. I mean, I can remember, back then in the late 1980s, I actually lived in Japan in the late 1980s, and people, there were loads of books at the time about, sort of the future is Japanese, and, taking over the world's number one, and then, for various reasons, a property slump, a bit like we've seen in China, actually.
Demographics
turned adverse, and years of, in fact, decades of deflation, not inflation. So it's very interesting when you look at not Hong Kong. When you look at Japan now, people talk about inflation coming back, and they talk about it as a positive. We're so used on this side of the world to thinking that inflation is a problem. They're delighted that they've got a bit of inflation coming back, wages are growing fast. That's giving people more money to spend, and that's seen as a positive.
Okay. Well, let's turn then to the slightly more expensive end of things. We've got a group including Switzerland, Canada at 26 times, Canada's 25 and a half times. Two very interesting examples, I think. Taiwan at almost 30 times. And the Netherlands at 33 times. Both of those markets, quite small stock markets, but dominated by very, very large individual companies. So in Taiwan, you've got the Taiwan Semiconductor Manufacturing Company, TSMC, and then in the Netherlands, you've got ASML, another chip maker. That distorts everything, doesn't it, in these numbers? So you can kind of put an asterisk next to each of those.
Yes, and I think it's a lesson in treating these numbers with a degree of caution.
You've got to know more.
In the case of Taiwan, you are really talking about one stock.
Yeah.
I don't know what the exact figure is, but it's something like 70% of the value of the Taiwanese stock market.
Yeah.
It's just this TSMC, this chip making company, which of course is very important in the whole AI story. It's been a very successful company, and it's driven that stock market. So yeah, as you say, you do need to know more.
Mm-hmm. And right, let's get to the top of the pops really. We've got India, 33.2 on the Cape, which is very interesting, especially in relation to what we were saying about China before. Those two markets are interesting to compare. And then, of course, the US stands at the very top of all global markets, which is quite a thing because it's the biggest market as well as being the most expensive. 36.4 Cape ratio. Very, very, very expensive. That's perhaps why people have been looking elsewhere this year as alternatives to the US.
Yeah, it's one of the reasons. And of course, one of the reasons why the Cape ratio for America is so high is because that market is dominated by a handful of big technology stocks, which themselves are very highly valued. And it's concerns about that AI story is one of the reasons why we've seen this rotation out of the US, but it's not the only reason why the US has fallen out of favor. Another reason is to do with this whole sort of trade war narrative, the tariffs, which are big news this week that we're speaking in, of course. And so, yes, when a market is that highly valued, it becomes vulnerable to bad news flow. There is an inverse link between the starting valuation of an investment and its likely returns. I mean, it's loose and it's difficult to predict when it will kick in. But broadly speaking, if you buy a market when it is expensive, you should expect to enjoy less good returns than if you buy it when it's cheap. So I think investors are latching onto that, and they're just concerned about what's going on in America.
Yeah, and it's a reminder when we're talking about these numbers, you have to have a number, but you have to have a view of the future and an opinion about whether that's going to change and what might change that number. So in the US, clearly the rapid rises have been driven by tech, a small group of large tech companies, and it's going to be the ability of those tech companies to just continue to grow at the rate they've been doing and to fulfill all the promises that are now priced into their prices, but also without competition from elsewhere. And that might be the key question when it comes to those companies, that actually they might not have it all their own way. And we've seen bits of that this year, haven't we, with developments of AI competitors? Yeah,
that's right. I mean, valuation is by itself not a reason to expect a movement either up or down in the short term. You need a catalyst. And we very much had that catalyst at the beginning of this year when we had this announcement from DeepSeek, a Chinese AI company, that it had managed to replicate some of the success of American AI companies at lower cost. And that changed the whole narrative about that had been underpinning the performance of those big technology stocks. And these things are always only clear in hindsight. And it may well be that we look back in a few years' time and say, that DeepSeek announcement in January 2025 was a really important catalyst for that rotation out of the US. It may not be. But at the moment, it looks plausible.
And just finally, before we wrap it up, what can we say about this method of investing, of using valuations and focusing in not, because if you were very, very rational, this is how you'd invest, isn't it? I mean, you would look at this and say, well, a market that's cheap now, if I've got a long enough time horizon and I invest when it's low, that's going to pay off, or the chances that it will pay off are much higher. It's harder to do it in practice, and as you've said there, you can be kept waiting a long, long time for these rotations, these reversions.
Yeah, I mean, you've identified the problem with that approach because, yes, if you've got a very long time span and you're extremely patient and you're willing to accept being wrong for quite a long time,
Yeah.
then I think the evidence is that this, effectively what you've described there is what's called a value investing approach, where you buy things that are out of favor, that are cheap, and you wait. And the evidence is that it does work over time. But for many years, that investing style has not worked. It's been out of favor because the market's been driven by these high growth companies that have looked expensive but have just got more expensive.
Yeah.
And I think that's the psychological aspect to this, that doing the right thing can sometimes look like the wrong thing for quite a long time, and people find that very difficult.
Okay. Well, that is all the time we have now for now, Tom. So let's leave it there. I'm going to point everyone to Richard's excellent article, which has all these numbers and many more. That's at fidelity.co.uk. Just look for the Markets and Insights section. You're going to find it there. So for now, Tom, thanks for joining me.
Thanks, Ed.